you've seen a lot of slides the last 2 days, and I'm not sure how many I might show again, but I'm going to try and slice this in a different way, and hopefully you see some other ways of looking at a similar phenomenon. So let's just go. So every week in the letter, I update commodities, ETFs, treasuries, exchange rates, just to see what's happening every week. And this is for all of 2025. So as you can see, the equity silver equity ETF is the one that outperformed everybody, followed by the gold one, and then remarkably the PGEs on either side. If you're interested in rare earths, I actually found because we have a rare earth company, there is actually an equity ETF for rare earths. But it's got a blend of lithium, so you got to take a little bit of that. Finding benchmarks for what you buy, I find it very important. That way you can see if you're just getting beta or if you're actually achieving alpha returns. For copper, this one is really good, COPX. For silver, again, the SILJ, uranium URA, and then this is actually lithium carbonates. LIT is the lithium one. But as you can see, everyone did well. I'll throw in a few slides of what gold actually looks like. This is from Southern Cross Gold's Sunday Creek, an antimony gold play. It's in the portfolio. This is stibnite. That's the coarse gold. So these assays, this is like 0.16 meters, but this is like 3,330 grams with about 11%, almost 12% antimony. So this is a gold price. So this is all of 2025, with this being that bit of 2026. So this 30% jump, a lot to do with just the new administration taking their spot, and then Liberation Day, which was the introduction of those tariffs. Then this was, will he actually do it? And so nothing actually happened here. We had a big pause. And then we had the idea that maybe interest rates will actually go down, because here we were thinking that the tariffs would bring inflation and actually the rates would actually go up, not down. Other demand, like central bank demand, probably held gold straight. In a normal market, this probably would have reverted. And that's the big thing that you see in gold over the last couple of years. When it should normally have fallen, it doesn't tend to fall. And then the next step was the idea that the interest rates would be cut twice. And then we had, towards the latter part of the year to mid-December, when people were ready to go on Christmas vacations, we had Venezuela. So the ongoing geopolitical issues that do not stop, that's obviously helped gold. Usually these impacts are ephemeral. They don't last for very long, but you finish with one and you're in another. And so this next steep rise was all Greenland and the potential imposition of new tariffs on Europe. And we just heard about 100% tariffs potentially on Canada just this morning. And so that's what's driving gold up to about 5,000. And people were saying that we'd hit 5,000 in 2026. It's not a big deal right now. So this is a slide about multiple currencies. So when I worked for Newmont and Pierre Lassonde was the president, he used to always show us these slides internally about if gold is rising in all currencies, then that's a bull market. And so as you can see, here's some producing countries: Australia, Canada, China, producer and consumer; Japan, consumer; US, consumer and producer; India, consumer; and the Eurozone, mostly consumers. And you can see most of the increase has been in euro dollars. Potentially, even though the US dollar actually got weaker in 2025. And that's all related to tariffs and more people buying gold in Europe. But as I'll show you, they're buying gold everywhere. And so before, a lot of it was central bank demand. And so as you can see, like historically, the quarterly average demand from 2010 to about 2022 was about 10 to 11% of total demand for gold was central banks. Since about the beginning, post-COVID, the central banks started buying much more gold. And so that average went up to about 24 to 25%. It's gone back down in terms of total, but it still exists. But most of this was generated by this, mostly ETF demand, exchange tradable funds. So these are basically percentage changes in the assets under management from the previous year. And you could see the biggest growth was Asia. That's Asia right there, from next to nothing to bigger. But also the biggest slice is North America, which is basically the US, and that grew. So most of what we saw in the latter part of the year was ETF driven, partially because of cuts in the interest rate that were coming, but also here and there, the impacts on tariffs, supply chains, embargoes. And so if we look at this, again, indexed gold price here, and what we're interested in is the impact on equities. And this is just pure beta, because if you don't want to do a lot of work and you just want exposure to gold, I highly recommend the ETFs. You don't need to pay anybody except for them, but you could see the kind of leverage you get. So the first pump up in gold, because of Liberation Day and that 30% increase in gold, was a 1.6 multiple on the GDXJ. The next time gold went up, you got a 2 times. So now you got more people interested in equities. And then the next one, you got 2.4 times. As people were leaving for vacations and that, it went down slightly, 2.0, but we still had this kick right near the end of the year of 18%. And so if we look at it historically, since the GDXJ actually began trading back in 2009, this level, we're hitting that again. But since it peaked early in its trading, it's never come close to that level. This is the closest it's ever come. And so what I try to do is show our subscribers what alpha is. And so this is the benchmark, GDXJ. I would argue that the explorers do not have any beta to gold. That's not why you buy them. You buy them for exploration success. And they would provide an alpha, but that all depends on the drill holes. So if you want pure beta, go for a producer. What's changed is the orphan period for developers. That's what's done really well in the portfolio, because people see the idea of where's the next growth coming from, who's going to get acquired. And that's why companies like Liberty here outperformed the GDXJ, even though they're a development story and non-cash flowing. That's why Southern Cross, another advanced exploration story in Australia, outperformed. So here's another one that I put together, is that we all talk about, well, here's the gold price, which is not even on this graph, $5,000. The dark blue is the reserve prices, the last reported reserve prices, which are usually the end of 2024. They'll report in February 2025, but it's based on 2024, and the price is based on 2024. So they're lacking what's happened in 2025. But you could see the average for reserves, proven and probable, is about $1,662 an ounce. You go up less than 300 ounces, $300 an ounce, $270 an ounce, you get up to the resource price. This is the 3-year moving average. This is usually the price that people put in technical reports. That's what it would be 26. But obviously, that's about 45% of where the gold price is right now. So the question is, what are the new technical reports going to use? What are the banks looking at? I'd say the banks would probably go with this number. They'd be okay with that, maybe even a bit lower, like 2,500. But what are companies going to price their reserves and resources at? And so in terms of financing, this has obviously had a positive impact. So this is data from the S&P Global Market Intelligence up to October. So if you take that first 10 months, this is the number of transactions. The total amount raised, about $8.45 billion on different exchanges by intermediates and juniors, about 120% higher year on year. And if you went to all the conferences, you could see the movement. You can see the bankers, you could see what was happening, how many people raised not just once last year, but twice. And a lot of my companies that raised significant quantums of capital at the beginning of the year, they did it again in October, November. And that's why we have this big kick right here after the Colorado gold shows. But what we do see is that the people that can attract capital, liquidity matters. So the higher market cap that does the more significant capital raisings, they tend to get fed more. It's still some of the smaller companies that have trouble raising capital. That might be changing now, but that was definitely an issue because a lot of the companies that raised significant quantums of capital were companies that I thought didn't need money. But as Lassonde says, you feed the ducks when the ducks are quacking. And here's silver in Argentina, Argenta, which means silver. This is Diablillos, the jack deposit that they discovered themselves undercover, silver dominant. And then you get to gold and a high sulfidation system, Vagisilica at Oculto. This is the gold to silver ratio. I'm sure Peter showed you this earlier, but you can see that it peaked at 105, and that was just in March. So from that part, gold to silver ratio, the gold price was up 28%, as I showed you before. The silver price was only up 9%. So at this point, gold was about 34.25, silver 32. So that's about 105. That went down, and then when China was talking about restricting exports, that tumbled down to 50. So in this part, compressing from 150 to 50, gold rose 45%. But silver doubled. So as Peter was saying with his slides, it is because a lot of the demand is industrial. So you could see the problem here is silver production is flat. The mines are actually going down in terms of production, negative 1% CAGR, compound annual negative growth rate. A lot of that's being compensated by scrap. But what's happening is the growth is increasing. So unlike gold, which is more of a currency, this still has a significant industrial component, and that industrial component is rising. And when you take that industrial component rising in a market where you're accumulating deficits, then you can squeeze, especially when you announce bans on exports or limiting exports out of China. And so if you look at silver equities, like I showed you for the GDXJ, like we were just getting back to former glory, but we hadn't peaked, this is unprecedented for the SILJ. The last time when it started trading back in April 2012, it peaked around a little bit over 20. Now we're talking almost 40. And if you take silver equities, some of the companies we have, here's your Hecla. The one that's outperformed the most is Fresnillo because they offer dividends, and it's a lot of silver that they offer. They have the majority of Juanicipio. But you can see here is that's the SILJ right here. So Abra Silver gave us alpha, and that was a development play that raised significant quantums of capital twice in the year. And so you do that same reserve price, resource price that I did for gold. Now let's do it for silver. Again, blue is reserves, and the additional is resource. So the resource is about $21. Reserves are $21 per ounce. Resource, 24 average. There's a bit of a gap between 22 for your Torex and your silver standards up to 28 for First Majestic. The trailing average is 29, but the silver price is like 100. So the valuations will be interesting in terms of what the new technical reports come out in terms of silver, because a lot of these silver companies, silver is a byproduct and they don't really care about it. So they're not too fussed about what the silver price is. But some of these that have enough silver that if you change the silver price, then that could be the main product. Valuations. And so this is actually the one that we made the most money off. This was pure alpha, had nothing to do with the gold price. This was Origin's 1% NSR royalty on a deposit called Silicon Merlin that Anglo Gold Ashanti drilled. It went from 0 to about 4 million ounces in the Silicon project. And that was buried, a great discovery by Anglo Gold Ashanti. But then they found another 12 million ounces in another project called Merlin. Origin sits on the 1% NSR. And so in terms of M&A, we don't only talk about production, we don't only talk about development, but we talk about the royalty space. And the demand for this was insane because there's not a lot of royalties that are long-lived on a asset that could produce about 400, 500,000 ounces a year for 2 decades that is already operated by the person, the company that will actually develop it, which would be Anglo Gold Ashanti. So that supply and demand gave us, one of our better returns 15 times. And so in terms of higher valuations, this is done by Ron Stewart of Red Cloud Securities. So we follow this on a quarterly basis with him. But here is the intermediates majors, so these guys here, the producers, right? That's their curve. So their average is $373 an ounce. The average here is always more than the median, so it's asymmetric. And what's driving it are these guys. Who are they? Intermediates and juniors. They're the ones driving the valuations per ounce. On the resource side, feasibility stage, exploration, silver, it's 138 versus 77. This is for the end of 2025. See what's driving it? Feasibility stage companies. And then also silver, the blues. The light blues here, that's what's driving this. That's what's driving the asymmetry. And if you look at the returns, like the difference between taking this number at the end of 2024 to the beginning of 2025, the biggest was silver, 295%. The next up was the feasibility stage, gold. And then exploration companies, explorers here. The juniors, they didn't do as well. Intermediates and seniors, they gave you all the beta they could give you. And then it started taking off with these guys. But then if we look at just the 2026, just 3 weeks and 3 days. So this has gone up for seniors 19%, for intermediates 22, juniors 31, but silver explorers, and I showed you that they were the best ones at 290-something%, they went up another 44%. Why? Because silver price is $100. Explorers, another 40%. All these companies that are not cash flowing, 35 to 44% just in 3 weeks and 3 days. And so if you look at the number, it's $448. It was $373. It's $199. It was $138. That's what changed in 3 weeks and 3 days. Are we topping out? No idea. But as long as somebody has a social media account, and before the midterm elections, this could go on, because there's lots of countries you can acquire. And so M&A, this is one company we do have exposure to, not as Rupert Resources, but as Orion, the Ikkari project. So this is a gold development project that I've showed my subscribers has actually underperformed. The continuity in this project, the gold, is immaculate. It's open pittable, it's in Finland. There's no reason why this shouldn't be doing better. And I would say this year, it's got to come up. There's got to be a deal done on this one. And so if we venture out of the gold and the silver space, platinum and palladium actually outperformed gold, and platinum only underperformed silver. This is our only PGE exposure in Brazil. The Luanga PGE nickel project and copper project owned and operated by Bravo Mining. So what's driving this? Again, supply-demand. Cumulative deficits. Cumulative deficits drive down the global inventory and then would have an impact on the share, on the price, which it has. And in addition, the issues in South Africa with power, mines getting deeper, more infrastructure issues, labor costs. And then palladium follows, because palladium can be substituted for platinum. So if platinum runs up too much, palladium will start going. So if there is no, as far as I'm aware, PGE ETF, and so I took a bunch of PGE operators and some development plays. The one that's the most marginal, this Nickel Creek one in the Yukon, has probably done the best. Ours is down here. But in terms of development projects that I think can get built, I would put this one over that one. Copper. So I visited, I did 17 site visits last year. Cumulatively 4.5 times around the world, apparently. And one of these projects, I always like going to mine sites to see what's actually being done, what's being produced, and what kind of head grades. So this is the Caserones open pit that's now owned and operated by Lundin Gold. It was previously owned by a Japanese company. That's not photoshopped. That's actually the color of those facilities. It really stands out when you're on the hill. And it's an open pit, breccia pipes, and they run an open pit heap leach on the very low grade, run a mine, and they also run an SXEW on the enriched portion. And now they're looking to expand. This is in Chile. So why is the copper market moving? And that was up 40% last year, both the LME and the COMEX. The COMEX only blew up, the arbitration between it and the LME, when the US administration was thinking about putting a 50% tariff on copper cathode. It's obviously come back down again. But this is the issue again, projected cumulative deficits, and I would add the issue with copper capital intensity. The copper capital intensity is around $20,000 to $25,000 per ton of incremental capacity of copper. Some projects like Quebrada Blanca are $50,000 to $55,000. Ministro Ales, which is a project that Codelco just got permitted, that intensity is $93,000 per ton. So that's what's stopping a lot of projects from being built. So the copper market is now reveling in not only that, but these disruptions. And what does that generate? So when I worked as a market analyst, these are the things we'd look at. Not only would you look at the exchange price, and this would be on the cathode, but how tight the market is by the premium or discount to the actual public price, which is the market price. So here, it got to over 100, easily over 150 bucks per ton, that people were willing to pay over and above the LME price. to get a pound of cathode. And then the other product that you would produce is concentrate. And where does concentrate goes to smelter? The actual price is the treatment and refining charge, what we call the TCRCs. And when there is no concentrate, the smelters pay you. And that's when the TCRCs go negative. Why do they pay you? Because they got to keep the smelter running. They can't not have concentrate. And that's why China basically curtailed smelter capacity, because they were killing themselves. They were growing smelter capacity for copper at the same time there was no concentrate. So then they were dropping the TCRCs for their own smelters. So they put a kibosh on new growth. But still, it's very good for copper companies that are producing concentrate right now, especially if they're producing arsenic poor or no arsenic copper concentrates. And so if we look historically, this is the COPX from when it initiated in 2010. So this, just like the SLIJ, is in an unprecedented territory. Silver, combination of demand that's growing from industrial demand and the lack of mine production, which is compensated somewhat by scrap. This is mostly driven by supply issues, which are not going to change anytime soon. The biggest issue might be if Cobre Panama comes back online. And that's like 1.6% of total production. If that comes back online, there may be some easing. There'll definitely be easing on the TCRCs, and there might be some easing in the copper market if that news comes out. This, developers and grassroots. So we have Arizona Sonora here. This is Talon, which we bought here. That's now here. This is Arizona Sonora. This is the COPX down here. So about 160, 170%. We sold one stock here, but these development companies have far outperformed the equity ETF. And that's what we're looking to do in the letter. We're trying to beat this and hopefully crush it. This is why this crushed, because of this hypogene copper enrichment in a magmatic nickel deposit. There's very few examples of this globally. And from what I was told, the two examples are Voisey Bay and Norilsk. That got me excited. I bought it, and it continues to deliver. But the last run that they had, Talon Metals, was the acquisition and the deal they did with Lundin Mining to acquire the Eagle Mine and the Humboldt Mill. And now Lundin owns a significant portion of Talon, put in their own money, and also now they have two people on the board, as well as Jack Lundin and the CEO of Lundin Mining, as well as the ex-manager for Eagle is now the CEO of Talon. That also brought money in terms of base metals, up about 30% year on year. Number of transactions increased by 12%. So the average funds raised per transaction was up about 17%. So each company was able to raise around $5 million, which is significant. But again, this is asymmetric because the people that can raise tend to raise a lot. And the people that can't raise still have difficulty. And so this is the sentiment. So this is tracking the Metals Investment Forum. The darker gray is how many people show up in person. And then the COVID, when everybody went virtual. And there is a resonance in the virtual because people don't want to leave. But you can see here, in terms of 2019, when they had the September, this is the highest of in-person attendees at this conference. This is the highest total attendees in this conference since September 2019. This is the most companies that they've had. But they had enough food, I saw that. A lot of you guys were hungry, I saw that too. You guys should eat breakfast. Okay, multiple markets, resource equity, so everything all at once. That was 2025. Gold-driven, supported by central banks, but really driven by gold equity ETFs. Market deficits propelled silver, a squeeze, China restricting access to their own silver, improved access to capital, but very asymmetric. The people that could raise money did it in spades. PGE, market-driven. Copper, market-driven on both, mostly on the supply side. Low TCRCs and cathode premiums are what you want to watch, and both of them are positive for the copper market. And again, the last thing with copper, improving sentiment amongst retail, institutional equity, family offices in multiple jurisdictions. All right, that's it for me. Thank you.